Good afternoon, everybody. Welcome to Selecting Options Strategy. I'm Connie Hill. We meet each week at this time to discuss various option strategies you might consider. Today, we're going to talk about a process that we can follow in this class, and I'm going to say you could follow it in any type of trading that you want to be. We're going to work on that process and follow it throughout our class. Now, I am happy to have Cameron May in the chat. You guys all know Cameron. He's here to maybe catch some questions that I can't catch in our discussion here today, although I will be keeping an eye on the chat. So as you have questions, go ahead, chat those in. Those of you that are listening to this on the recording, and I know lots of you, that's how you view this. When you have a question, put your question in the comment section. I'll go back and answer those questions just as quickly as I can. Now, I hope you're following me on X. I'm Connie Hill, CS. Cameron does a lot of great posting as well. He is Cameron May, CS. And so give us a follow to be up on maybe some little nuggets that we might see in the marketplace. Let's go through our disclosures and discuss what our agenda is going to look like here today. Options carry a high level of risk and are not suitable for all investors. What we talk about today is intended for information and educational purposes only. Shouldn't be considered a recommendation of any sort. We'll be using the Paper Money software application. This is software you download to your computer. It's the most robust version of Thinkorswim. Investing involves risk, including the loss of principal. Spread trading must be done in a margin account. Past performance of any security or strategy does not guarantee future results or success. When we talk about probabilities, such as the probability of an option expiring in the money or out of the money, keep in mind those are theoretical in nature and are not guaranteed. All right. As far as our agenda goes, I have one quick announcement to make to you. Then we're going to review market conditions and maybe have some discussion about what strategies might be doing best in the kind of conditions that we're in. And of course, we're going to look at a lot of examples. We're going to put on some new trades. We're going to follow up on a couple of things, some trades from the past as well. So let's talk about the announcement. The announcement is this, just wanting you to be aware of upcoming workshops and market drive events. So May 30th and 31st is going to be an advanced option strategies workshop. So those of you that are feeling like you've got kind of the basics down as far as option trading go might really benefit from going to that workshop. And then we're going to have two market drives events in June, one in Miami on the 13th, the other in New York on the 28th. If you're interested, go ahead and sign up because registration does fill up, and when it does, we can't allow more people in. So if you have an interest, go ahead, sign up, and you can always cancel it should you need to. All right, these are generally the strategies that we're working with in this class. It doesn't mean they're all strategies, but it is a pretty decent share of them. Let's go take a look at what we're seeing in our markets and see if it might give us some direction as to if we want to be a little bit more bullish, a little bit more bearish, or if we want to be kind of have a neutral stance. So let's head on over here to my Thinkorswim. And we are going to start out with the SPX. Now on SPX, I know it's a little bit busy because I have a Fibonacci in here. I've got some moving averages in here. It might be appropriate for us to maybe get rid of our Fibonacci now that the market's actually bounced and we were using it to determine if the market were to bounce, where might that happen? On my screen, I have a 10 moving average. That's this light blue line. We have a 30. That's this red line. 100 days is the gray line and 200 days is the green line. And so we can see on the SPX, even though there was a period of time it was down below all of those moving averages, look where it is today. Yeah, it's above all of them, including the 10-day simple moving average. We see a pattern of higher highs and higher lows. Maybe I should go out of the country more often because as soon as I left, man, the market really started to recover. So you might have to send me off a little bit more regularly so that we can have bullish market conditions. In any case, I've got implied volatility on here so we can see kind of for whatever chart we're looking at, is the implied volatility high? Is the implied volatility low? just kind of what is it? And so on the SPX, you can see it really spiked here back when we had that massive pullback in the market. But over the last 3 or 4 weeks, it's just continued to drop. And then the other study I have up here is the relative strength. That gives us an idea of momentum. And we can see it's had some bullish momentum for quite a while here. It hasn't quite gone up above the 70 oversold area, but it's definitely been strongly moving in that direction. Let's take a look at the NASDAQ real quick, NDX. Similar type story here. For a long time, it was trading below all of those moving averages, found some footing, started to put into place some higher highs and higher lows. And some of you may have been a little bit more aggressive at getting in when you thought maybe things were turning around. And there might be others of you that said, I want a little bit of confirmation. Okay, so I'm not going to say there was one absolute spot that you might have felt good, kind of being a little bit less defensive minded and a little bit more offensive minded in a bullish direction. But you can see where we are right now. Let me maybe back up here a little bit. It looks like today the NASDAQ closed strongly above a resistance level. And in my little mesh, you can see here it's about, I want to say 20,912. Okay, something close to that. That powder blue line had been support, support, support. And yesterday gapped up real near that support, which would have been resistance on the way back up. And then today closing pretty calmly, or I would say maybe strongly above that area of resistance. So a lot of stocks on the NASDAQ index, on the S&P 500, both seeing very similar types of price action. And as we look, you guys have probably been paying a lot more attention to this than I have the last couple of weeks, but what we've essentially been seeing is the volatility levels continue to drop, letting us know the market is more offensively minded, more bullish, having a direction more bullishly, and just kind of keeps dropping and dropping. What does that mean? It means typically we'll see bullish market conditions, which we just saw on 2 of the major indexes. It also means that option prices should not be nearly as pricey or as expensive as they were when implied volatility is really high at some of these levels. That might also point us towards a strategy that we might think work good in these market conditions. Now, for those of you that are in here live, I want you to chat into the chat. I'm going to go back to our slides here. What strategy do you think might be working well, given what we've just looked at on the SPX, the NDX, and the volatility index, the VIX? I want you to go ahead and chat that into me. I'm going to head back to our slides here. Bring those strategies up as we talk through. Now, I would say we're probably in a situation right now where, let me get my marker at the right thing. There we go. You might be at a point you're like, we're probably not going to do a lot of bearish strategies. Could you do bearish strategies? You could. You would be kind of fighting against the tide of the overall market direction and momentum. But there could be a few that just fall in your lap that you might consider trading, even though you recognize that maybe they aren't the same direction as the overall market. Now I'm going to take a look here. Greg says, anything under bullish is something that he might consider. Robert says out of the money long call bullish. So being even a little bit more specific to a strategy as well as what strike price you might be interested in. Greg says long calls. Yeah, I would agree with you that any of these strategies might fall into something that you might consider. And I'm going to say there's not just one of them that you might navigate towards, okay? It could be depending on your expectation for the stock. I'd also say probably because the market is trending as strong as it is, many people might not be hunting for these types of strategies. I'm Condor, straddle, calendar spreads, and so forth, because we're seeing such maybe a condition of directionality, showing not just tiny little moves, bump it along, possibly going up, but more a stronger trend of seeing higher highs and higher lows. Okay, so I'm going to say I agree with those of you who decided to chat that in. Let's see. Greg says, yeah, it's refreshing to be above those moving averages. Absolutely. Isn't that the truth? Thea says, Thea followed me on my trip and says, you can work from Spain, which is where I spend a lot of my time. I could, but I was having a good time goofing off and sightseeing. So I did not, and I had limited connectivity. And so it wasn't really something I wanted to do. But you're right, I could have if I loved you guys enough. No, actually, it has nothing to do with how much I love you. All right. Ricebird also says maybe long call verticals. Okay, so I'm going to agree with that as well. Now, let's take a look at, I said at the beginning, a process that you might want to follow to determine which of these strategies you might consider as far as that first part. So we're looking for lower implied volatility. And quite honestly, I would say any of these strategies could be just fine. If we had kind of some higher prices because implied volatility was up a little bit, some people might consider spreads. There might be others of you that say you always do a spread. You never want to do just a directional long call or long put. And so some of your preferences might be coming into play here as well. So the first thing we want to do in our process is determine, are we more bullish or are we more bearish? By looking at the charts, we've determined we are a little bit more on the bullish side of things. What should the second thing be in our process? And that should be, how much time do we want to allow a trade to take place? If we're doing something directional, say like a long call or even a synthetic stock, which would be, I'm going to say, very bullish, your time frame might be shorter, kind of maybe in swing time frames, meaning maybe you're only interested in trading something for 3 days to maybe 8 days, something of that nature. Or you might be more inclined to say, well, I'm going to do a spread and have more time. Typically with spreads, whether you're a buyer or seller of a spread, many traders will look for this window of time to be between 20 to 40, sometimes up to 50 days, as far as how much time they intend to be in the trade. Now, if we get out of the trade, say we put on a vertical and we're out of the trade in 5 days, oh, we are happy campers. We don't mind that whatsoever. All right. Let's see here. Myron says, probably for you, as far as time goes, you like to do between 2 days till the option expires to 7 days. Okay, so you're looking for a fairly short time frame, which is, you're going to have those personal preferences. There might be some of you that go, wow, that's too short of time. But as you become a little bit more experienced and you trade more and you're really comfortable with your strategies, there may be some strategies that you don't mind being in such a short time frame. Okay, although I'm going to say it definitely is more aggressive, and probably for somebody that is really comfortable with the rules and how they might approach a shorter time frame. I'm going to say it's been probably a couple of months, maybe even 3 months. One day we watched time decay. All right. And in that time decay, we looked at an option that was going to expire. Actually, it wasn't in this class. It was in my short verticals class. We were just watching time decay as we had our class. And that fell in the time frame of a 0 days to option and its expiration, because I wanted you to see the time value just melting away because it was so close to expiring, that time decay was so rapid that you could just visually see it happening on the screen. You could do that kind of an experimentation if you wanted to. I had done it on the SPX and did 0 days to options expiration, and it was taking place while the market was open. Now, you guys know the market right now is closed, right? We heard the closing bell just as I came on. Now, let me look at what else Myron says here. You say that has worked for me, but I've only been trading since November of 2024. Fantastic, Myron. That is fantastic. You're also saying iron condors. So what you might be looking for is basically selling premium in a really short period of time and taking advantage of time decay just being super rapid. Well, today we are going to focus probably on a couple of strategies here. We're going to be focusing on a long call, possibly if we get to it. We're also going to focus on a long call vertical. We'll go into more of why as we get into it here. Now, the first one we're going to take a look at, let me jump back to our Thinkorswim, is Palantir. Now, Palantir was up pretty significantly here today. It was up a little bit higher when I put it on as a potential trade. And it was looking like it was busting through this old resistance about 124.95. And you could see it ran up to it here, pulled back, ran up to it again. And when I was looking at it, it was near its high of the day. And one thing you can do to see, okay, it looks like maybe it's breaking out, but you're maybe not sure if it's a big enough move. Some people might feel comfortable with it if maybe it's penetrated the resistance by 2 or 3% or more. And there may be others of you that say, I want to see that it something a little bit more than that, something that is a little bit more meaningful than maybe just barely. If we pull up our calculator here and we put in 124.95, and if I multiplied it by 1.03, that would give us 3% beyond the 124.95. That would be 128.69. Now, some traders will look for a penetration beyond resistance or beyond support of stocks trending down about 3%. Why is that? Technicians that are published and I'm going to say well recognized in the field, some of them have published something that says basically if you penetrate a support or resistance area by 3% or more, is likely to continue in that direction. That means today we would have wanted to have seen this stock close about 128.69. It's a little bit short of that by about 59 cents, but for some of you, it might be worth it. We're going to go ahead and pursue it. Okay, we're going to pursue this trade. We're noting its implied volatility is down pretty low. And sometimes what you can do is you can come out here to say, I guess we are on a year. Let me just kind of zoom out here. Something that's helpful is to see, well, where has high implied volatility been? And I would say definitely right here, that value was about 1.22. And then here recently was about 1.18. So somewhere in the neighborhood of, say, about 1.2. And now, right now, it's at about 64, which is a lower value. The lowest it's been in the last year has been down here about 0.34. This one is 0.42. This one right here is 0.51. Okay, so those seem to be the lowest levels. And even though it's not down there at those lowest levels, I would say it's in the bottom third. Okay, meaning, all right, implied volatility is fairly low. The option prices shouldn't be super expensive like maybe they would have been up here in higher volatility types. Hopefully that makes sense. In choosing a strategy then, somebody might decide, well, if implied volatility is lower and not higher, if it's higher, sometimes they'll favor some selling strategies, right? Some short put verticals, short call verticals. If it's something where volatility is a little bit low, some people might consider more just buying strategies, would that be a long call, long put, or doing some verticals. On PLTR, I'm going to go to the trade tab here and get rid of all that there. I was doing some comparisons earlier. On this, we are going to look at the June 6 options. They have 24 days before they expire. In this account, we're willing to risk $1,500 per trade. And we're going to be very careful about trying not to exceed that as we're putting on those trades. Okay. Now, as I look over into the chat, I can see we have a survey. And from time to time, you guys that have been here before know that they'll put out a survey to kind of get your feedback on what's going on in this session here today. Now, we are a long way from being finished, okay? But what I would hope you would do for us is just click on that link and let it sit in the background. Wait till we're done with our class, and then if you would, just fill out the survey. It's 2 questions. You just fill in the radio button, plop, plop on a scale of 1 to 10, how you feel. There are also 2 places you can answer questions that come to me as far as, hey, I'd like to see this, or I'd encourage you to use it as a space if you want to communicate something to me to say, hey, could we cover in one of our upcoming classes X? Or I'm having a difficulty with Y, whatever that happens to be. And I'll try to loop those comments and questions that you have into our upcoming webcasts. All right, so if you fill one out, I promise you I will read it. In fact, I read every one of those. So do our managers. It's important feedback for us. So thank you, Cameron, for posting that again out there. All right. As far as our trade goes, 20 to 40 days for a spread is what many traders will look for. We're going to use these June options. And let's see if what I had identified still makes a little bit of sense. One thing that's nice here in the weeklies, and not all weeklies do it this way, but we have single strike in increments. Okay, that allows you to be a little bit closer to maybe the strike price you most desire versus the monthly here that is in $5 increments. Okay, so maybe not as easy to get your ideal, but if you have enough open interest in a time frame that you're interested in, you could pursue that. Now, the price closed at 128.10 today. So we're going to start out here at 128, kind of our at the money. We're just going to say buy vertical, and it's going to grab that next strike in sequence, right? So it's spreading it out by $1. We're going to go ahead and spread it out a little bit more. We're going to change this 129. Excuse me. Make sure I started on the right one. We want it to be, instead of, this does not look quite right. Let me populate this again. Okay, here we go. I'm on the right side. I was over here looking at puts, and I was like, that doesn't line up. Okay, so we could go 128.29 or spread it out by an additional $1, which puts it at 130. Sometimes that can help your efficiencies in terms of commissions. Sometimes you can run those numbers and you can see, does it make more sense to divide it, spread it out by 2 strikes or 3 or 4, whatever have you. If some of you are trading a real smaller account, then it can be really helpful to just have those $1 wide spread increments, right? Because if you wanted to participate in this, instead of paying $800 a contract, you could do it in a spread, and you could be risking 43 cents or roughly $43 on the trade. And that can be really helpful if you're trading, say, a $10,000 account and you need to keep your quantity fairly small. We are going to spread it out a little bit. Like I said, let's make this the 130. It's going for about 80 cents, which if the whole trade went against us, everything in the world went wrong against us on that, we would lose $80 per contract. Okay. What do we have to gain? We're going to take the difference in the strike prices, which is $2, minus 80 means we'd have $1.20 as our max theoretical gain. Now, I'm going to kind of put some numbers out here on this scratch pad. Our step 1 was, make this so it's not italicized here. And we'll just make it white, okay? We wanted to determine, are we more bullish or bearish, okay? So I'm going to call that our posture, okay, if we're more bullish or bearish. Number two in our processes, are earnings out here? Are they a concern? If so, that might shorten a time frame or lengthen a time frame, depending on if you wanted to trade over earnings or not. This stock already had its earnings. They're essentially out of the way, right? That took place last week. They gapped down a little bit. That gap has been filled. And then today, kind of reaching a 52-week high here at 130.6 was as high as it went. Okay. So in terms of time frame, earnings are out of the way. That's not a concern. And so we'd get into, okay, how much time do I want to be in the trade? If you were somebody that just wanted to be in the trade for a very short period of time, say 3 to 8 days, kind of a swing term type thing, you could. Just know the options are going to be more expensive because you're just buying the option outright. In this case, it would be $8 times 100, right? About an $800 investment or net debit on your trade, just going long without a hedge on it, without putting it into a vertical. Now, how many of these could we do? Well, if our max risk is about $1,500, we could do quite a few of these, couldn't we? We could say, all right, $1,500, divide that by $80, says we could do about 18 contracts, okay? We wouldn't want to exceed that, but I am going to go ahead and put this at 18. And actually, let me do this again. 1,500, yeah, divided by 80. That should be okay. I just wanted to make sure because that seemed a little bit higher than we typically do. So we could do 18 contracts here. Now, when would we get out? Okay, time frame, we're going to say maybe 20 to 50 days on this one, okay? And then is the volatility high? Is the volatility low? We decided by looking at the implied volatility on the chart and where the VIX was when we did our market posture, okay? We could say volatility is in the low area, okay? So that's what led us to doing more of a long vertical versus just a long call. You could possibly do a long call if you wanted to. You could only do one in this paper account, this example account, because if we did two and we lost everything on the trade, that would be $1,600, which would be more than what we're willing to risk per trade, okay? So quite a bit of difference here. Now, let's change this to first trigger sequential. Let's put in an opposite order, and this will be an order to get out. Since 80 is our max theoretical loss here, our max theoretical gain should be what? Should be $1.20, right? If I come down here and I say max gain equals 1.20, how much of that gain would we be satisfied with reaching? That's something short of 100%. Would you be a happy camper if it made 50% of that gain? How about 75, 80, 85? Right? You can decide that. What we've typically done in this class, and it doesn't mean we do it on every trade, but we've been kind of targeting about 70%. If we can get a chunk of it, not all of it, but a big chunk of it, we're going to be happy, be satisfied, take the profit, move on to another trade. Okay? So here, let's see. If we take $1.20, which is our max theoretical gain, and multiply that by, let's say we get 70% of it, that gives us a value. I'm going to say 70% equals 0.84. Would be satisfied with getting 84 cents of the $1.20. So we'll take our 0.84 and add that to our 0.80 starting point. That's where we would like the price to be to in order to get out. So just some quick math here says we should be able to do this at $1. Let's see, $1.64, right? 0.84 plus 0.8 should give us $1.64 here. We would make this good till canceled because we don't know if and when it might happen. We just don't want to have to go set it up every day. We'll go ahead, we'll hit confirm and send, and we are going to send it to our option strategies bucket. All right, market's closed, so I'll be watching those in the morning and make sure we get filled on the trades that we put in here. All right, next up, let's take a look at another stock. And some of you are going to ask, where did I come up with these examples that we're using here today? In our short verticals class, we created a search that we're using for all of our trades. That class I teach on Thursdays at, I guess it would be 2 Eastern time that we teach that class. And we came up with a watch list of stocks that we decided were very liquid, that we would trade them either bearishly or bullishly. We didn't care what direction we would trade them. We wanted to have them be fairly liquid, and they all came off of the S&P 100 and NASDAQ 100, which are typically going to be more liquid stocks. So we ran the search again the last time we had that class with me there on April 24th, okay? We've been using these same stocks for our choices in this class as well. Okay, so I just started going down looking for, had a 1 week, a 1 month, you can't even see a 1 in there, but this is the performance over the last month. And then this last one was over the last 3 months. And I maybe can change that up a little bit so you can see it. Looking to see where has there been some strong momentum, and do we have a potential entry point, right? Of those potential entries, we'd consider on the bullish side, if we have a support bounce, a close above the high of the low day, a moving average bounce, or maybe a breakout of resistance or a breakout of some price pattern. And so on our PLTR, we were looking at a break of resistance. Now this next one, as we look at it, Tesla. Now this one, it had a lot of higher implied volatility in this period of time when it was just selling off. Man, implied volatility was really high, but it's continued to drop after it maybe had, like, say, a quadruple bottom, which is a potential reversal pattern. Usually we'll look at a double bottom or a triple bottom. In this case, it went down and touched it again, giving it 4 touches along that 215 line. But then it started putting in, more recently here, the higher highs, the higher lows. And it too today looked like it broke through some resistance at about 326. We could do the same thing on it to see, hey, did it get 3% beyond that? And let's say 326.42 times 1.03, because technicians that are published and respected say if it penetrates more than 3%, is likely to continue that move. Okay, that would put us at 336.21. Well, did it close there today? It closed lower than that, right, at 334. So there might be some people that are like, I would like to see it be penetrated by that 3%. This works out to be about 2%, and some people might feel comfortable at 2% as well, not requiring the stock to be 3% beyond. Okay, now this is an expensive stock, isn't it? 334 today. Even though volatility is low, the option premiums, they're not going to be as high as they were back here in higher implied volatility times. They are significantly lower. And let's see, kind of the really low areas, this looks like 0.55, this looks like 0.54, and right now it's at 0.66. So it's still really quite low. So we're going to pursue either a long strategy, okay? If somebody wanted to and had the account size to buy an option outright without making a spread, certainly could do it. But these are really expensive options, right? $2,300, $2,560. But some accounts that might be just fine. For our purposes, for our class, we can't do that, nor are we going to, because if we were to lose, say, this option here that's $2,300, that exceeds what we're willing to risk in this class of $1,500. So by default, we're going to put it in a spread. Now, I do have here open. My open interest is this column. My volume, which is today's activity, is this column. You can see, man, there is a ton of activity out here. So no worries about that. We're going to be in our smaller range of our window of 20 to 40 days worth of time. Again, we can't do the long option, just the long call. So we are going to do a short or a long vertical here. I'm looking where it closed. It closed at 334. So our at the money strike price is going to be 335. Okay, so it's slightly out of the money, but it is our closest. So that's our at the money. We'll start there and we'll say buy vertical. This one doesn't have single dollar increments, but it is a pretty high priced stock. And so it's nice it has $5 increments. In the monthlies, if you were to take a look at that, and I'll just show you real quick, they're in $5 increments as well. Okay, but we're going to use this shorter time frame. So we are going to come up here to the June 6th, and we've done 334, 340, so a $5 wide spread. So if we take $5 minus our theoretical max loss of 220, that should give us what? That should give us 280. I'm just going to write this down in here, that our max theoretical gain is 2.80. And if we get a chunk of it, again, if we get 70%, let's get out of the trade. You can decide what that number is. All right, let's go ahead and calculate it. So we'll say 2.8 times 0.7. That would give us $1.96. Okay, so $1.96 is 70% of our max theoretical gain. We're going to add that to $2.20. So let's just come in here and select the plus on our 196 to 2.2. That says 416, go buy it back. We'll go first trigger sequential. We'll create an opposite order. And for purposes of our trade, in terms of how many contracts we can do, we take 1,500, divide that by our max theoretical loss of 220 per series of contracts. That says we could do 6. Now that's for risking $1,500. Your account may be completely different. So take that into consideration. So we're going to change this to 6 contracts. We're going to change this to 6 contracts. In here, we're going to put in that value of our 70%. We decided that was going to be, I did not write that down. I should have. 196 plus 220 was the 416. And I'm going to put that over here in the side. And that's what we'll put it in here. We'll say, hey, we get a chunk of the max gain. We're going to be happy campers. We'll go ahead and set this good till canceled and send it on its way. Now, we are just going to do a day order here on the initial entry because our expectation is we're going to get filled close to that tomorrow. Once the market opens, we'll put this in our option strategies bucket. Now, I want to check our chat, see if there are any questions that I need to answer. I think Cameron's been helping out a lot here. Thank you, Cameron. Ricebird says, you know, you like to go for 50% of the debit in the trade for what you're looking for. Fantastic. Not a bad idea at all. Let's say John says 10-day moving average is about to cross with the 200. Is that on a Tesla? Let's see here. Looks like 200. Was that the one you're referring to here? The 200 on mine is the green line, and this gray line is 100. So it looks like it closed above the 100 today, as well as a little bit beyond that area of resistance. Okay, on that. Now I want to spend a little bit of time on looking at some trades that we put on in the past. Now, I've been gone for about 2 weeks, and I did not follow up on any of our paper trades in case my connection was really spotty. And so pretty much I left things alone, which from some of the trades that we had done, put them in a bad situation. So what I did this morning is I went in, just cleared all those trades out. Okay, got them out of our account. At most of them, some significant losses. But what I want to do is pull up a couple of those with you and look at the chart to determine when maybe should we have been out of the trade. So the first one I'm going to pull up here is APTV. Now this was a short call vertical that's due to expire this week on Friday. We got into this trade right here where this green oval is, and we did a short call vertical. And basically we were looking for the stock to stay below the 55, which was our strike price. All right. And it did it for quite a long period of time. It stayed down below the 55 strike. Sometimes people start to get concerned. That might have been a little bit too much here. A little bit concerned if it goes above that short leg, right? They're like, oh, we really wanted it to stay below there. And here it is crossing above there. With verticals, you know, it's possible it may cross over your short leg and be there for a little bit of time and then pull out. Now, as you look at this here, some things some people might consider it as getting out or a signal for getting out. One could be if it's above their short leg for 3 days in a row. Okay, it went above our short leg right here, 1, 2, this day on, looks like the 29th of April, would have been the third day beyond our short strike price. And if it's looking fairly strong bullishly, somebody might consider getting out at that point. The other thing I was looking at here is that it was a strong close above that area, but also above its 30-period moving average, which is more of an intermediate time frame, right? So somebody could have used the rules for that. Now, some people may have said, well, I want to hold over earnings, which you certainly can. In our case, we didn't really want to do that. So probably our day to be out of the trade, the first day, would have been around April 29th. Now, more likely than not, this could have resulted in a loss on this trade, but not nearly as big of a loss as it would be today, looking at it for the first time in 3 weeks to see what was going on with it, right? So definitely different places to exit the trade. The other one I want to pull up here real quickly is we did several put calendars. Now, put calendars, that was kind of our first approach of trading a whole bunch of them in this class because we were in neutral market conditions. And so we did a calendar that was a put calendar, which means a little bit of bias to the bearish side of things when we do a put calendar. And we got in on this day here, looking for it to be a little bit out of the money. Now, the one thing somebody could have used as an exit signal, this stock was trading in a channel here. You can see kind of the green lines, and this dotted line was the halfway point of the channel. And sometimes that acts as resistance, and we can see for a long period of time it didn't go above the halfway in the channel. But on this day here, which was the 29th of April, again, it crossed above that midpoint of the channel, and that could have been a signal for some people to be out. They weren't out on that day, maybe a couple days, trading days later, right here, as it crossed above that 30-period moving average. Maybe it's the idea, gee, this isn't going our way as much as we would like it to, and so consider closing out the trade. Now, I hope all of you are following us. I hope you are subscribed to our Trader Talks channel, because when you do, it makes it so much easier for you to be able to find our content, right? Here's our Trader Talks channel. You can see some of the things that just happened recently. You can see what's coming up. This is the last class today. Tomorrow's first class will be the Trader Talks in today's market. That'll be Kevin Horner, and I'll be joining him first thing in the morning. But you can see what is coming up. So it makes it really easy for you to find our content, including going down playlists and going through some of those classes from the past. Now, just as a reminder, I will remind you that there is a survey out in the chat. We always appreciate you taking the time to fill that out for us. Okay, just your input, 2 buttons on a scale of 1 to 10, plop, plop, and then if you want to answer any questions. I promise to read everything you send in, and our managers do as well. Well, that is about the time for our class that we have available today. So we kind of outlined a process we're going to follow, maybe more specifically than we have in the past, determining our posture, bullish, bearish, neutral, what strategies we might be inclined to do based on implied volatility, and how much time we want to be in the trade. All right, you guys have a great evening. We'll see you again bright and early in the morning, right at the opening bell, which will be 9:30 Eastern time. Cameron, thanks for your help here in the chat as well. We'll see you tomorrow morning. Bye-bye.